A ban on TikTok, China Vanke in trouble, this time a state-owned enterprise in China's bubble of a housing market gets a delay on its bond repayments. Country Garden misses a payment. The Hang Seng Tech Index enters bull market territory, and so much more happening as always in China's financial markets. Welcome to China's stock market, a weekly recap where we go through all the things that are happening on the mainland and in the second largest economy so you can make better decisions in terms of investing in its stock market. I'm your host, Jack Kuzi, and without further ado, we've got a lot to get through. So let's get started with our disclaimer. As always, just remember, any information that I give you is for information purposes only. It doesn't constitute a recommendation to buy or sell equities. Remember, it comes at a risk. I try to keep everything as factual as possible, but you got to do your own research. And remember, most of the times I'm just giving you my own personal opinion, although I believe that's an informed opinion, and I've got a lot of opinions for you today on this week's show. Our numbers are building very slowly, so hit that like button. Subscribe on YouTube if that's where you're watching right now. If you're listening to us where you get your podcast, leave us a 5-star review. We try to cover as much detail into China's stock market. We think it's undercovered here, even though we talk a lot about China's economy, its geopolitics, its relationship with the rest of the world, its military, but not necessarily about its stocks too much. Well, in comparison to the US, not enough, I say, and we do that here. All right, let's go through the agenda. As always, we're going to do quick hits. Not many quick hits this week, so that'll be fairly quick. We'll talk about market performance. A choppy week because of the TikTok news, housing sale news, kind of the lagging effect of the two sessions. We saw some policy moves out of China, particularly around its MLF rate, which remained unchanged. So no more stimulus coming out of the Chinese regulator. But again, a choppy week. Nonetheless, if you look at the mainland bourse, it actually entered its 5th week of gains, which is the first time it's done that since 2022. So there you go. Biggest news was TikTok. Second biggest news was definitely Vanke. We'll talk about CATL and how it popped off the back of some JVs. Baba continues to make moves. Man, if I didn't like Baba before, I really like what Baba's been doing over the last 3 to 4 weeks. Particularly, I talked about this last week, particularly about, I guess, just the doors being blown off the hinges, them being allowed to make moves by the regulator, by the by the Communist Party, I think puts them in good stead off the back of a okay earnings report, which we covered 4 weeks ago. I'm going to talk a little bit about oil and a big discovery by CNOOC. Productive forces, we saw the premier visiting tech companies around China and what that means. XAOMI surges, but not why you think. And last week I told you I was going to go through BiliBili Earnings, and I'll do that at the back end. Whew. Got to take a breath. A lot to get through. Got to keep my breath because there is so much to go through. Let's just go through quick hits firstly. Only one quick hit, and I thought this was an interesting one. There was a McKinsey report during the week that talked about, how inclined are Chinese to purchase a EV or purchase another EV. And it said that 22% said they wouldn't consider a new energy vehicle for their next car. Why? Now, this is in contrast to the 3%, which was recorded in 2022. And the reason for that is the lack of charging stations. Apparently, if you drive through Beijing and Shanghai, you can see cords dripping down windows with people plugged in to their EV car to get them charged overnight. So I thought that was interesting, considering we've covered a lot about EVs in the last couple of weeks, particularly with some reports coming out. So that's the only quick hit. But I will refer to last week's quick hits where I talked about SOE developer Vanke, China Vanke, ran into an issue extending a loan from a mainland asset manager. That's exactly what I said last week. And then without further ado, this week, it was probably the second biggest news coming out of China. We know what the biggest one was. We're going to cover that first. But before we do that, let's talk about the market performance. Shanghai Composite up. Shenzhen Composite up. Big week for the Shenzhen Composite, 3.5%. Like I said, mainland indexes 5 weeks in a row, that's the best since 2022. Hang Seng down on Friday 1.42% off the back of some hotter numbers out of PPI out of the US. However, the weekly performance up 2.74%, bringing the monthly performance to 7.33. 6 months still down. Year to date, 2.42. Interestingly enough, during the weekly Hang Seng Tech Index, measuring the largest tech companies out of China, of course, was in a bull market. So 20% from the absolute lows. And you can see the Chinese market has been really, really hot in the last couple of weeks or the last couple of months. Pretty much in line with us launching this show. Can't take too much credit. But that's because we detail a lot of policy support. I believe some really good indications that the market is turning around, particularly around consumption. We saw good Lunar New Year numbers in terms of travel. We've seen some decent earning reports from some companies, some not so decent ones, mixed bag, but there are some nice good pockets there showing that the Chinese economy is not going to fail, like everybody thinks, is not collapsing, and in fact is somewhat strong. Wouldn't say it's strongest ever, wouldn't say it's bulletproof, but we've got to remember this is the second largest economy in the world. In my opinion, the most complex economy in the world, and in my opinion, the most valuable and important economy in the world. Yes, I said it, more important than the United States of America, but that was the market performance. If you have been invested in Chinese markets, whether on the mainland or in Hong Kong, you have done quite well this year, that's for sure. All right, let's get into the first topic, and it is the TikTok ban, and that was probably the biggest news. Now, this hit on Wednesday, Sydney time. Now, normally I film this on a Friday, so I'm actually filming it on a Saturday morning. My wife's been away. I've been looking after both my two girls. I look after them all the time, but fully looking after them. So I didn't get a chance to film this on Friday, Sydney time. It's Saturday. I've come into the office. Just dropped them off at their grandparents' house. This dropped on Thursday. So Wednesday night, my time, Wednesday morning, US time, whatever you want to call it. Anyway, biggest move, the House of Representatives passed a bill potentially banning TikTok in the US. All right. So the bill went in and the bill was passed, resoundingly, 352 to 65. That was the vote. All right, so let's unpack this for a moment. Now, TikTok is owned by ByteDance. ByteDance is not a listed company on a stock exchange. You nor I can buy it. It's only available through private equity, and none of it's getting sold at the moment. So what are we covered on the China Stock Market Show or the China Stock Market Channel? Well, it's got long-lasting effects for other companies. If they ban TikTok, who else will they ban? Will they ban Temu? Will they ban AliExpress? Will they put a full ban on Chinese EVs coming into the US? Where does this start and where does this end? Right? Now, there are 170 million US users of TikTok. So a couple of questions we've got to answer here. And this shook up, particularly China's tech companies and their performance over the week. How likely is this ban? How likely is it that this ban will come into effect? Well, firstly, it's got to go through the Senate, and then President Biden's going to sign off on it, and then there may be a legal challenge to it. You got to think, if it got passed resoundingly in the House, why not in the Senate? Now, the House doesn't have as many people seeking re-election. Senators got a longer-term view. Their asses are not on the line, if I may say so, as quickly. But you got to think, if you're looking at bipartisan, both Democrats and the Republicans, pretty unified on this one thing, make sure we protect ourselves from Chinese incursions. You got to think this might be likely. So it's a big move. It's actually a really, really big move. Now, the Senate Majority Leader Chuck Schumer has not committed to the bill, and senators have expressed mixed opinions about a TikTok ban. So, in my opinion, this is big news, could likely happen. Why? Why are they doing it? Well, if you remember, in 2020, there was a move to divest TikTok from its parent company, ByteDance, and Oracle and Microsoft were going to look at it, and Trump was going to do a deal on it. My understanding is that ByteDance chose Oracle, but it never went through because the Biden administration came in and they kind of let it go. If you ask me, what are the chances of ByteDance divesting their TikTok ownership and selling it off to remain in the US, I would say minus 100%. Okay, maybe that's a bit too much. I just don't think it'll happen. I don't think the Chinese government will allow it to happen. I don't think the CCP would allow ByteDance to divest it. One, they want to keep the asset in Chinese hands. Two, I don't think they would kind of, lose face by allowing that to happen. Now, remember, TikTok has jumped through a lot of hoops to be in America. Okay, there are a lot of things. They've spent billions of dollars on infrastructure to keep the data there, to keep their centers there, etc. Like US companies do in China. Microsoft does the same thing to cooperate in China. Tesla does the same thing to act in China. Apple does the same thing to sell phones in China. Both companies or both countries' companies do that to participate in these major markets. Unlikely I think they would divest it. Why are the Americans doing it? Well, they're doing it. The initial reason was data harvesting. So they were concerned about, keystroke, watching your keystrokes, analyzing your keystrokes, therefore knowing what you're searching for, therefore taking that data, selling it or giving it to the Chinese government and spying on US citizens. The big issue now also is misinformation. What's being said on TikTok, and I think there's been a couple of things in the last months or couple of weeks that have resonated or highlighted or made this an urgent need for the House of Representatives to vote for it. The first one is the Palestinian-Israeli conflict and some of the things that were shared on the TikTok platform. And the second one is around the US military and how it's going to run out of money and things that are operating there. Misinformation happens everywhere. Instagram, X, YouTube. Hard to stop it. I think the other big point here, particularly for other Chinese companies and listed Chinese companies and your portfolio, if you're invested in Chinese tech companies, is the whole policy around this kind of iron curtain or this technological curtain that the US and China have been battling over, is that the US had a strategy of small yard, high fence, right? Will protect really, really, really technologically innovative assets, AI, semiconductors, etc., small amount, but we'll put up a high fence. This is an expansion of that yard. It is an expansion of the yard, and if it comes through, it's almost a bigger yard with the same type of fence. What does it mean for other companies? What does it mean for Pinduoduo and Temu? What does it mean for Shein and its IPO? What does it mean for AliExpress and its moves into the US and its expansion there? What does it mean for BYD, for CATL, for Lee and its expansion into the US? What does it mean for Apple in China? What does it mean for Microsoft, which does a lot of business in China? What does it mean for Tesla in China? It's just got waving consequences. And what we know about the Chinese government and the CCP is that they are they reciprocate. I'm looking for a different word, but you hit us with a ban, we'll hit you with a ban. You hit us with a ban, we'll hit you with a ban. You bring up your fence, we'll bring up. This is where we're getting into in terms of this territory. Now, some might say, there's a bit of lobbying by the other tech companies. Maybe. I'm sure Meta would be happy if TikTok were banned. But I don't think that's the overarching reason. The TikTok algorithm is better. They're better at doing it, but I don't think that's reason. This is politics. This is geopolitics. that affects the stock market because companies are caught in the middle. The other question that you got to think about is how do they enforce this thing, right? So let's say you do ban TikTok. You remove it from the Apple Store. You remove it from Google Play. What happens if US citizens continue to use it? Do you send them to jail? Do you give them a fine? Do you build the internet firewall that you hated the Chinese for building when they built their national companies like Alibaba and Tencent and Meituan and Baidu? How do you enforce it? That is another question that I cannot answer for you at this point in time. Will this happen? If you would ask me 4 weeks ago, a year ago, would have said unlikely. Now, this is 50-50. You got to think with an election, everybody wants to be tough on China, think it wins votes. It's not political, it's not anything. I think it's just plain facts at the moment. But this was a big piece of news. A big piece of news in geopolitics and a big piece of news particularly for Chinese companies who are doing business in the US. And when I think about them, I think primarily of PDD and Pinduoduo. And I think about Chinese EV companies. Now, they're already getting hammered. There's talk about national bans or security on Chinese EV companies because it's collecting data. And data is, the most important asset in the world. But this was a big move by the House. Still got a lot of runway to go. But nonetheless, not good for US-China relations. And not good for for Chinese tech companies. And US tech companies also. Because you could see some retaliation around closing off some of their markets for US companies in there. So if I was a GM, I'd be worried. If I was a Tesla, I'd be worried. If I was an Apple, I'd be worried here. I would be worried. So if I was a Meituan or a Didi or an Alibaba or a PDD, I'd also be worried at this move right here. But that was probably the biggest news coming out of China and the US and in relation to Chinese stock markets this week. Got any questions about it? Let me know in the comment section. I'll be happy to answer it, but I might even do a standalone video on this going forward should we see more news develop. All right, so if it wasn't for what happened with TikTok, this probably would have been the biggest news story, and this has some long-lasting effects around the strength of the Chinese economy and I guess the recovery, which we know has to start, or at least begin, which is the same as start, but has to have some roots in the property market rebounding. Now, what is happening in China is that Chinese citizens, we're seeing secondary sales of property start to bounce, right? But primary sales, we're not seeing any bounce. And what's the difference? Primary sales are, there's a building going to get built over there. Who wants to buy it? Put your deposit, you get your property in 3 years. Secondary sales are, it's built, someone owns it, they sell it to you. Because the Chinese are worried about their properties getting built and they're avoiding anyone who's had trouble. That's why Evergrande can't get itself out of the hole. That's why Country Garden can't get itself out of the hole. Now, we thought that China Vanke was one of the safer ones. Why? It was government backed. 34% owned by Shenzhen government or an association with Shenzhen government. 2, it was high-grade bonds. Okay? It was actually included as a high-grade bond out of China in a lot of ETFs and indexes. Then we get the news, people are calling their payments. Where's my money, China Vanke? Local Chinese institutions saying that. We started talking about that last week in the quick hits. Then it accelerated, right? Their 2025 bonds to Wednesday. So this is a bond. When you buy a bond, when they sell a bond, you give them money. In return for that bond, they give you a rate of return, right? So when they say they're defaulting on their bond payments, that's that return they promise to pay you, either monthly, quarterly, yearly, whatever. You give them $100 for the bond. They give you the rate of return. And at the end of the bond, they give you the $100 back. Okay? So the 2025 bond was trading at $71, 71 cents. To get 71 cents back. Not good. Right? Now that was trading at 67 earlier in the week. The 2029 bond was trading at 44 cents in the dollar. So if you think about that, you gave them 100, your bond is now worth 44. So the likeliness of them being around to 2029, the market is betting against it. So what happened? Why is this important? Let's break it down in the news. So one, China Vanke, around 30% owned by Shenzhen Metro, government backing. They've had sales drops. Okay, so Vanke sales in the first 2 months of the year fell by 40% from the previous year. Not good. What led to this kind of catalyst was Moody comes out and says, anticipates Vanke's financial flexibility and liquidity to weaken due to declining contracted sales, contributing to a downgrade of their bonds. Right? Then the long-term debt concerns start. There are concerns about Vanke's long-term debts, especially given the significant amount of offshore and onshore bonds maturing or becoming puttable by June 2025. All right, so a lot of debt to pay coming up in 2025. This led to a wider debt crisis that we've seen and had. Analysts expressed concerns about the impact of any repayment troubles at Vanke on the broader property debt crisis. Starts to flow on. All right. So then you start hearing news that they're going to try to avoid default. So Vanke's major creditor banks are considering swapping bond holdings into secure debt. So, all right, don't give us our debt payments on our bond holdings. Give us interest in property. Give us land. Here's a property. Give us 40 units. It's not how it works, but you know what I'm saying. And the company aims to raise $4.5 billion through a syndicated loan. Market didn't really respond to it really high. The concerns is that because these are high-grade bonds or considered high-grade bonds, if any other downgrades come from other rating agencies, that will lead to them being dumped in these indexes or these high-grade tracking ETFs, and that will lead to a further decrease in these bonds. There was some elements of government support. So following the downgrade, it was reported that China had urged banks to support Vanke, and including extending private debt maturities as part of an efforts. Volatile time for China, for its stock. So, off the back of the reports, it got hammered. Off the back of China's government support, it saw its prices increase 10.3 and 5.7. 10.3 in Hong Kong, 5.7 in Shenzhen. Vanke put out a statement stating its operations and refinancing were normal. So that was probably the second biggest news coming out of there. And its shares and bonds did react positively. But I tell you what, as an investor in China's stock market, as an investor in China's financial markets, you don't want to see Vanke go down. You don't want to see Vanke go down, particularly because of the high government ownership they'll have, which you think would protect it to somewhat. But who knows? Sometimes it's really hard to gauge what's in the minds of the regulators, because they're prepared to let some of these companies go down. We saw Country Garden miss a payment, an onshore payment, not an overseas payment, an onshore payment during the week. I read an article out of Kai Chin during the week that said, normally monetary stimulus comes in 3 to 6 months, the property market picks up. They've been doing monetary stimulus, short, sharp monetary stimulus for 2.5 years, hasn't seen it pick up. It's in a lag. Often people have said it's going to be a U-shaped recovery. The question is, how quickly does that U go down? Or how far does it go down? We also saw continued weaker sales. Feb sales will continue to be weaker. Yes, the decrease and the sharpness of the decrease is, the acceleration is decreasing, but still nonetheless, no confidence amongst Chinese citizens in its property market. We know how important its property market is. It's 25 to 30% of its GDP. And you want to see its property market stabilize, because the argument is if China is going to continue to grow, if China is going to recover, it has to be a consumer-led recovery, not an export-led recovery like it's been in the previous decades. And in order to do that, Chinese largest asset needs to stabilize so Chinese citizens are confident to spend the money and not put it under its bed and not save it. And to avoid a Japan-style no growth numerous decades, because they were paying down debt because asset prices had fallen and therefore you didn't see consumer spending. So when it's an interesting point that we're seeing happening there, but China's property market, while stabilizing, still has hints that it could decrease even more, and issues like China Vanke and country card continue to arise. Now remember, we saw a decrease in ETF buying by the national teams during the week in the last couple of weeks. So the question is, when you're looking at China's economy, is where is the growth going to come back? Where's the growth in markets going to come from? If the regulator and the government doesn't want to stimulate and the fundamentals aren't there and they're not there yet, where does the growth come from? And that's the question investors are asking themselves. Look, Alibaba is my third largest Chinese holding. But I've been buying a little bit now every couple of weeks, just a little bit. I like to dollar cost average. And I just like the moves that they're making. And I like the regulatory space that's opening up for them. We talked about their AI investments last week. $600 million investment in a $2.5 billion company. We talked about how this is a sign that the regulator was done with watching what Alibaba is doing, was allowing it to grow again. During the week, we saw Alibaba commit 640 million or 5 billion Hong Kong dollars to invigorate Hong Kong's film and TV industries, aiming to bolster cooperation and revive the city's cultural scene. The investment will focus on copyright purchases, TV series, film production and performance, etc. Alibaba's second headquarters for Digital Media Entertainment Group. I think it's just another move. It's the move that follows success of the Queen of the News on Alibaba's streaming platform, Youku. It's expanding its presence in all key six sectors that it has. And I think Alibaba is going to reclaim its place as China's largest company going forward. I believe it's just a matter of time because of its broad base it has in different industries as opposed to someone like a Pinduoduo. Although that was an interesting piece of news coming out of China, a small piece of news, but continues to further my belief that Alibaba is now in an expansion phase and is going back to a growth style company, which should help and increase its multiples of its stock. Hopefully anyway. All right, let's take a look at CATL. It popped, increased 14% during the week due to collaboration with XAOMI and BAC Motors, you can see in front of you if you're listening on YouTube, and an upgrade by Morgan Stanley. Its mainland listing rose by 179.97. It's got a Hong Kong listing as well, marking the biggest one-day percentage in over 3 years. Morgan Stanley upgraded CATL to overweight. We talk about CATL. I think it stands for Contemporary Amperex Technology. 30% of the world's batteries. It's got 49% of China's EV battery sector as general. So they foresee CATL as a long-term cash cow with free cash flow yield rising from 6% in 2024 to 10% in 2026. Good indication that dividends might rise. Despite concerns over weak consumer demand in China, demand for CATL batteries is expected to remain strong. Battery pricing competition is easing and CATL's margins could outperform expectations. CATL, XAOMI and BAIC are collaborating on a new battery cell factory venture in Beijing, with CATL holding 51% stake in it. So a really good week for CATL. We talked about their earnings a few weeks ago. This is a standout Chinese company, a standout Chinese company that is positioned to really grow if you believe EVs are going to be everywhere. If you believe the combustion engine is going to be zero in the future and it'll all be EVs, which I think is almost irreversible. I know you've seen some car companies come back, move into hybrids. I think it's almost irreversible. I think this is a long-term geo trend, a mega trend. These guys are positioned because they just make a really good, efficient battery. The other one that had a real big pop during the week was this one, CNOOC. So if you don't know who CNOOC is, China's largest oil company, or China's largest energy company, or second largest. Let's take a look at this. The share price is up 55% for the last year. This thing gives you a yield of 7.67%. And it's trading at a PE of 5. You want to talk about dividends? China's stock market's probably one of the best dividend markets in the world and had a history of paying them. You want income? Go and have a look at China and some of these companies, particularly their energy companies. Their banks also gave a great yield. You've got to deal with a bit of volatility. If you feel like the financial sector is collapsing, you probably wouldn't invest in them. But you want to talk about dividends? So what happened? They discovered a deep water reserve, oil of 100 million tons of proven oil equivalent. This is in the South China Sea. The location of it was in Kaiping South oil field, 300 kilometers off Guangdong's coast. The shares are up 8.94% for that high. It reached a record high of 30.5 yuan per share. The Hong Kong listing, which is the one that I'm looking at, also raised 4.2%. It's the first deep water oil field reserve exceeding 100 million tons, founded in the South China Sea. You talk about China insulating itself from the rest of the world. You talk about strategic industries. When you talk about Xi and Chinese leaders talk about strategic industries, self-reliance, ensuring that they can continue to move. This is one of them. They obviously import a lot of oil. It's a commitment to the South China Sea, so there's a lot of spending and a lot of R&D by Chinese company. In fact, CNOOC has invested more than 76 billion yuan in domestic exploration in the South China Sea. The Chinese want to have the South China Sea because of the natural resources under it. They hold about 67.1 billion tons of oil equivalent, constituting 34% of China's total oil and gas reserves. A big reserve, big area of expertise or area of need for the Chinese. And the more I look into this company, the more I think, do I want to buy some of this? Even though it's moved 55. Have a look at it on the chart. It's been incredible. I often deter away from oil companies, oil and gas, because I feel like it's a dead industry. We're moving away from them. But it's hard to ignore some of the balance sheet of this company, the dividend yield, and the PE. Now, you might think it's a value trap, and I can understand why. But this one's certainly on my radar. Any retracement of this price, if it does happen, I would be looking to. But I just think in terms of dividends, China's a great market to look for. You know what? I might even do my top 5 dividend stocks within China. How's that sound? That would have to be Hong Kong listings because foreigners can't buy mainland stocks unless you get a special dispensation. But there are plenty of Chinese companies listed on Hong Kong that provide really good dividends and a possibility for growth. There's no point getting a 7% dividend and the stock's losing 20% a year. But some great dividends and a history of paying them out, I will say. But that was a big reserve that was found on a massive Chinese company. A massive Chinese company which we don't talk about because we get lost in the Barbers and the Meituans and the Didis and etc. But a big reserve finding. And you've got to think in terms of strategic benefit to the Chinese company. If they continue to find reserves in the South China Sea, it reduces its dependency on Arab oil, on Russian energy, and insulates them somewhat. Because this has always been a weakness of the Chinese economy. It's energy dependent on other countries. And therefore, it's thrown into geopolitical events because it has to, because it needs that energy. Question is, do we continue to find these deposits and these new findings? And that would certainly insulate China's economy and help that in the long term. All right, so we've heard this new term by President Xi and other high-ranking officials within the Chinese Communist Party of productive forces. Let's entice productive forces. Let's develop productive forces. For me, it is a sign to the Chinese tech companies from the regulators, from the CCP, to say, hey, we know we came down hard on you, 22, 23, 21. We're happy with how things are going now. You got clean runway. Go and innovate. Go and be technologically innovative. Go and dominate. Go and win in new industries. Go and produce in new industries. And the fact that we saw Chinese Premier Li Qiang visit tech companies, including Baidu, which as of yesterday was on a 5-day winning streak, tells me that Beijing wants to promote these industries, wants to get behind them, and also wants to give executives and management and shareholders of these companies the green light. And I think it's more, when you look at investing in China or China's stock market, and you think about some of the risks, and we covered this 3 or 4 weeks ago, that regulation risk, I think that's over. I really do. And they're going to be allowed to grow. And when I look at where I want to put my money in what I believe is the most important economy in the world, and what I believe is a market that will continue to recover, and what I believe in that when we talk about the companies of the future, when we talk about the Microsofts and the Amazons, etc., we'll be talking about Chinese companies in the same breath, if not more, in my opinion. That's my opinion. And I look to the tech heavyweights like Baidu, like Meituan, like Baba, like Tencent, and I think to myself, these guys are cheap. Plus, I believe that Chinese technology eventually will be better than US technology. We see that in areas of EVs. We see that in areas of solar, renewable energy. There are areas of technology where the Chinese are simply better. I believe the US is still the number one, but China will overtake them. And I think the premier visiting companies like Baidu, like Nora Technology Group, like the Beijing Academy of Artificial Intelligence, is saying, let's go. Yes, we've been going for decades, but now we're done. We're going to allow you to grow. We're going to allow you to go into industries. Don't get out of line. Don't get out of check. Play by the rules that we tell you, and we might change them every now and then and quickly, but we want to innovate, we want to grow, we want you to expand. We want you to expand domestically, but we also want you to expand across the globe. And we saw tech companies have been rallying. We talked about the Hong Kong Tech Index being in a bull market, and I think that's because of policy support, but rather a kind of notion from the government to say, we're done. We're not going to clamp down on you unless you do something really stupid. We're done. We're going to allow you to grow now. And I think that's really important as an investor. If you believe that, it kind of creates a runway because valuations are cheap. And when I think about Chinese companies, particularly its tech companies, I think the next area of growth is going to be overseas. Because when you talk about great economies of the world, we talk about them and their militaries and their banking sectors, but we talk about their companies. All right, let's go to the other one. That was XAOMI. So XAOMI, phone maker, second largest phone maker in China, second to Huawei, second. So then XAOMI, then Oppo. They surged 7.5% in Hong Kong on Tuesday, not because they came out with a new smartphone, but because they announced the long-awaited sale of their SU7 electric vehicle. This will go on sale on March 28 in 29 cities, the company said in a Weibo post. Yeah, I mean, not a car enthusiast, but it looks good. And it looks like a Porsche. So that popped 7%. You know, we saw Apple pull out of the EV market. I don't know if I think it's a good idea that XAOMI gets into electronic vehicles, but who am I to say? But that had a pop during the week. I think it's a good company in terms of its phone making. I think it's a great phone. If you talk about XAOMI and other areas of businesses, the Internet of Things, connecting devices together, XAOMI I think is a great place because they do a lot more. They do a lot of electronic devices, you know, weight scales. I believe they do like electronics and fridges, etc. And connecting them, you know, talk about, you know, connectivity. I think XAOMI is one of the best Chinese companies that are well placed for that. Plus, it's a great value phone to buy. So that SU7 series will be released on 28th to see how sales go and see if it gets a pickup, considering, you know, there's a lot of competition in EVs in China. Probably not the best one. All right, now let's end with BiliBili. This came out last week, but I did want to touch on it very, very quickly because, you know, it's not the top tier of tech companies within China, but it's certainly in that second tier when you go past Meituan, Alibaba, Tencent, Baidu. You're talking about that second tier. If you don't know who BiliBili is, it's a video sharing platform. It's kind of their version of YouTube. Not exactly, because it's a lot of gaming, animation, and comics. But they had their report. It was good. It popped off the back of it. So it beat expectations on earnings per share and revenue. It did report a Q4 loss, but it was better than expected. It narrowed its annual loss to $682 million US or $1.65 per share. It's been in decline since the start of the year, 11% and 50% over the last 12 months. However, they talked about achieving a 41% increase in gross profit with a gross profit margin of 24.2%. They also said that they're averaging 100 million daily active users and 336 million monthly active users. And they had plans to integrate ads with content ecosystem and an improved ad infrastructure. And they narrowed their adjusted operation and net loss, which the market liked. It did pop on the back of that. I think, look, is this, you know, a top buy for me? Definitely not. However, the reason why I included it is it's just on the back of what I would say is a B plus reporting season or earnings season for Q4 for Chinese companies and Chinese tech companies in general, considering everything that's happened in China. And as a group, I think something like a Chinese tech ETF, even with the 20% rally we've seen off the lows, I think if you're thinking long term and you're thinking that this domestic consumer in China is going to come back, then these companies, along with the Alibabas and the Tencents in a type of ETF, are a good purchase going forward. All right, that's it. That was the week within Chinese equities. We kind of covered 9th to the 16th or 10th to the 16th of March. I'll be back next week as always. If you haven't subscribed, please do. Hit the like button, leave me a comment. And as always, and if you're listening on podcasts, give us a 5-star review. And as always, guys, good luck with your investing.